We will now talk about the state of the hedge fund industry. Where is the hedge fund alpha in the shifting market landscape? So please allow me quickly to introduce my panelists today in the order up there. From left to right, Robin Curry, Director, Hedge Fund Originations from Bank of America. We have Jackie Rosner, Managing Director of PAMCO Prisma. Art Vinokur, Managing Director and Head of Manager Research, 𝐏𝐀𝐍𝐶 Advisory / Franklin Templeton. Samuel Weissen, Portfolio Manager of LGT Capital Partners. Some of you might think that this is an all-star basketball team because the average height is about 6'6". I'm a point guard, by the way, and I'm from former Yugoslavia, so I think we always like to win. On that note, today we will cover the various hedge fund strategies, some innovative approaches to generate alpha and manage risk, such as use of AI, data, and AI portfolio management. The strategic approach in manager selection. We will be discussing differentiated hedge fund strategies in challenging macro environment, which we just discussed half an hour ago. The importance of diversified and non-correlated return streams. So we are not really long or short, we're trying to make alpha. We're trying to make money in any market conditions. It's important to point out that lots of hedge fund alpha is masquerading as beta, and the alphas of yesterday are today's smart beta. What are the alpha today that will commoditize into the future? That's also the topic we'll be discussing. And lastly, why have so many managers been falling, lagging the indices, and what strategies are most and least likely to benefit from Fed's pivot in interest rates? So lots of ground to cover here, but let's cut to the chase and start with Robert. What strategy do we currently deem favorable or less favorable, and why?
Excellent. Well, thanks very much, first, all of you, for being here. Obviously, to Vidak and team, who've done an excellent job. It's great to be here with, as they said, maybe the future former Yugoslavian basketball team. But all kidding aside, I think from a strategy standpoint, right, there are a couple of strategies that you can point to. One that I'll just touch on that maybe people aren't as aware, given that maybe a lot of you have institutional clients, or maybe you allocate on behalf of let's say tax-free folks, but the tax-aware strategies are quite popular within our wealth channel right now. The firms that you might be familiar with, AQR, Gotham, and some others are doing a lot of work to try to find ways to offset either short-term capital gains or actually, believe it or not, long-term capital gains. So I would say right now, given the uncertainty, what's going on in Washington, the election obviously next week, there's so much happening that we're selling hundreds of millions of dollars a month in tax-aware, or some people call it tax-advantage strategies. In terms of a strategy that's probably not as popular, both on the macro side as well as within our channel, is really emerging markets. Not sure I personally agree with it, but I'm just speaking from a macro level, no pun intended, that ultimately, the dollar's been strong. EM should be a good place to go, but we haven't had any traction there. And ultimately, I think EM debt could be an interesting play. I think it's started to gain traction this year, but I would say with the uncertainty right now, it would be difficult for me to make a call beyond that.
Thanks. Moving to Jackie.
Thank you, Vidak. I want to give you a big thanks for inviting me today. I've attended many Beryl Elites conferences in the past, and I always look forward to it. So I really appreciate being on this panel, and to do so with colleagues in the industry who I know quite well. So thank you. Very exciting time in markets for so many different reasons now, with all the catalysts on the horizon. I mean, it is an election year. There's a change in monetary policy. Some things have worked out better than others, and there's a variety of different strategies that still are very exciting. Anything positively convex is probably going to do well, because any vol-friendly strategies, some things that come to mind. So our focus at PAMCO Prisma is hedge funds, so everything we do is hedge fund related. But hedge fund strategies that are vol-friendly, like global macro, should do well. Things that have a vol-friendly bias. There's things to do across divergent themes and monetary policies globally. It's not just going to be, a long-only environment. People are questioning, we're coming off a year of a great 2023 equities and then 2024 equity highs even more. So people get a little bit worried that how strong can earnings growth continue? Earnings growth might come in a little bit next year. There could be some multiple contraction. So people need to be able to play longs and shorts. And the reason I say strategies like a global macro is like you saw what happened on August 5th. There was that, we all had this bad dream of that one-day move where Japanese equities hit, a correction that we hadn't seen since 1987. VIX moved that week 45 points, which is the biggest weekly move we ever saw ever. Dollar yen getting crazy moves, crypto came off. It was just this very short-lived event. So to be able to express views long and short, there's a lot of alpha to generate. But other than just global macro, there's a lot of other strategies within equities that we're leaning into. We think that even within tech stocks, AI is still going to be a very long-term theme. There's going to be a lot of disruption and innovation across hardware, cloud computing. There's going to be winners and losers in the space. It's going to be an environment, good environment still for stock pickers. That doesn't seem to be something that's going to end anytime soon. Within healthcare, pharma, biotech, also very exciting area. Pickup in M&A. There's some interest from large cap pharma acquiring some biotech technologies, and that looks like it's going to be something exciting. All the innovation and the benefits we've seen from those obesity, weight loss drugs, GLP-1 drugs, it's a huge game changer, and it's going to be expressing views and trades, within equity long short. It's going to be exciting. Within energy, it's not just a bet long energy, short energy. There's going to be a lot to do within dealing with decarbonization, green energy transition, trades within traditional energy and renewables and things like that. So within equities, there's going to be plenty of pockets and sectors that should do well. Right now, the market, everyone here, we have a longer term investment horizon. We have the elections next week. The market's clearly pricing in now a Trump victory, could be a Trump sweep. Most people think that regardless what happens with the outcome, equities are still going to continue to grind higher. There seems to be some complacency. Even across the election, the market's not really pricing in any shock events. Vol expiring for the election is trading implied vols around 2% for that daily move. A few weeks ago, it was like 3%. Back in 2020, it was 4%. So like right now, the market's not really too scared of election being much of a catalyst. But it's probably going to be, equities will grind higher, but there'll be plenty of opportunities to go long and short. And I think in some of those sectors should be some good alpha there.
Thanks, Jackie. Just next time when you speak, just close the mouth. Not from here. Ark, on this note, tell us about your
Sure. Is this close enough? First of all, again, thanks for the invitation. Lovely event. I love this stage. It's a very unique place to present. I'll maybe take a different tack in answering this question, thinking about what does it take to make a good hedge fund strategy? What makes hedge fund strategies attractive in a specific point in the cycle? And usually it's a collection of things. It's some sort of inefficiency, some sort of a moat, and then tradable opportunities. Trading opportunities emerge out of market volatility, out of uncertainty, out of a greater dispersion. And this year has been full of those, and frankly, we're obviously not yet done with the volatility that's coming potentially in the election cycle. Whichever way the outcomes pan out, certain sectors will do better than others. We are expecting to see a lot of dispersion in different sectors, different markets. That's what hedge funds, that's what alternative investing in general is for. It's capitalizing on those inefficiencies, capitalizing on market movements. So through that lens, Jackie stole some of my thunder, but we think discretionary macro certainly, because it's more of a forward-looking strategy and it's able to pick up opportunities not just in equities but across markets. Political events, changing interest rate cycles, different central bank behaviors, all of those are tradable events for discretionary macro in commodities and fixed income and currencies. The biggest area of growth for our business has been risk mitigation strategies. Macro is a component of that, but so is volatility trading. there's not too many things in traditional institutional investors' portfolios that will make them money in a sell-off. Whether you're looking at public equities, fixed income, long commodities, private equity, private credit, those are all long risk, those are all pro-growth strategies. There's not a lot of stuff out there that can be anti-growth or serve as a hedge. So volatility strategies certainly can be that. And then if we talk about the flows in our industry in general, private markets, look, there's been a lot of popularity for a couple of years. It died down a little bit in 2022, but it's been coming back. We see that by the amount of capital that's being raised in traditional private markets and private equity, private credit, but also at the intersection of all of these markets, rescue finance, capital solutions, different sorts of restructurings, preparing for the next default cycle if it ever comes. So private markets definitely are getting a lot of attention for us and others.
Thanks, Ark. So pretty much it's okay to be correlated in up markets, but it's important not to be correlated in down markets. So Samuel, can you expand a little bit, perhaps lessons learned from LGT Capital, and also tell us about what works and what doesn't?
Sure, and thanks for having me also here on this great panel in this unique location, so thanks for that. In terms of what we see as attractive or what works, I would second what was mentioned also in the previous panel in the sense of active management is back to some degree, because we have seen since COVID, volatility and dispersion has picked up, and we believe that this creates a lot of opportunities. And we believe, for example, systematic strategies have done pretty well over that time, be it on the macro side, be it on the quant equity side. And we believe that that will continue to be the case if we see still an uncertain environment with bouts of volatility, but still sort of underlying shifts. And then when we look at specific strategies, it's obviously great to go last because everyone already mentioned some things. But maybe to add another element, like this place, it has kind of a retro feel, but it's still very cool in this time. And we talk about AI, but it's still valid. And we believe still there's some strategies which are maybe also classic strategies, which still have a place today and which are actually quite attractive. So for example, we see ILS or reinsurance markets is kind of attractive at the moment. It has had a pretty difficult period from 2017 to 2022. Since then, we still see sort of a lot of catastrophe events in the world, and insured losses are going to be, again, over 100 billion this year. But we believe that from an investor perspective, a lot of things have improved. And actually, the rates going forward look quite attractive, and it's an uncorrelated return source. So that's something that we like. Also, convertible bonds, for example, also classic hedge fund strategies has seen a lot of shake-up. The index level returns haven't been that great. But when you kind of dig deeper into it, we believe that from the concentration of that segment, there's a few players who are actually in a very good position to sort of earn structural premia from kind of exchanges, as companies don't want to have their sort of convertible bonds mature, and also from new issuance, which is sort of picking up after the start. So we see kind of many areas where we like it, and also on the healthcare side, I would second that in the sense we have seen kind of sort of the slump in 21, 22, and now we kind of have this resurgent as a potential opportunity. For us, we don't try to sort of bet on that on a beta way, but we would rather look for specialists who are able to earn money from sort of this higher dispersion, but then also have the ability, if biotech is sort of coming back, to sort of dip a bit into that without having a huge tilt in that direction.
Thanks, Samuel. Rob, tell us about, from a private wealth perspective, that's where you're sitting. Are you guys looking more for multi-strategy managers, or you're more on single hedge fund managers level?
Yeah, absolutely. So clearly, the multi-PM model has been big across, I think, all types of allocators in the last 5 years. Clearly, the growth of assets has been exponential with recent news, large fundraising ability, shall we say, from some of the bigger names out there. But for us, I think that's always part of the menu. So just to be clear, what I do and what my colleagues do at Bank of America, also known as Merrill Lynch Wealth Management for our particular business line, we create the menu, right, that our 14,000 advisors order from. It's about $90 billion platform, 20 billion in hedge funds, 70 million in private markets. So we're always going to have, because what I like to create a cheesecake factory menu, right? It's supposed to appeal to the widest possible audience out there. For those who haven't been there, you can order sushi right next to fried chicken, right next to pizza. So if you haven't been, definitely check it out. Please, I'll get paid later from the Cheesecake Factory folks. But kidding aside, I think there's severe alpha degradation going on in the multi-PM space below the top tier. And so it's something we've spent a lot of time sort of dissecting what we can put together in terms of the data we have available. The bigger sellers for us are taking on Sam's viewpoint of old school hedge funds, right? Going back to the 80s where people were opportunistic, right? That they could go across the capital structure, maybe with a macro aware tilt. Those have been funds that have been selling and really resonating in the private wealth channel, at least when it comes to us. As I mentioned, tax aware, big one, right? We're in a couple $100 million a month fundraising in those strategies. And it's basically, specifically, forgive me for not mentioning it earlier, quantitative market neutral strategies that have some sort of tax component, tax overlay to that. And then last but not least, I would say macro is definitely out there, but more of a defensive play for the ultra high net worth set. You're definitely seeing also macro changing, the ever evolving landscape of the single risk taker of yesterday is still out there, but not as prevalent. So I would say the multi-PM is here to stay, but we're very careful to make sure we're finding people who can really generate not only alpha in the near term, but sustainable alpha over the long term.
So, Jackie, what excites you the most in your particular sector that you cover? Also, I believe your sector doesn't really, it's not that related to AI and alternative data. Is that correct?
Yeah, I'd say more of our systematic managers would use more AI technologies in their process than discretionary macro. But what does excite me, based on a lot of these market moves and the inflection point where we are now, is a lot of these global macro strategies. When you look at what just happened recently, just looking at the third quarter, we had two-year Treasury yields rallied 120 basis points. Two-year Treasury yields shouldn't rally 120 basis points to have such an abrupt about-face turnaround. And it just goes to show you, that this long-awaited begin of this rate cut cycle, usually it's a little bit more obvious and telegraphed. People thought it was going to happen at the beginning of this year. It didn't. People were betting on rate cut steepeners. It didn't. Then all of a sudden, at once, you get this change of perception and sentiment, and it happens. Goes to show you, to be able to generate alpha in global macro trading strategies could do well in these environments. You look at movements in dollar-yen. In the third quarter alone, just recently, dollar-yen moved from 160 to 142. It started the year around 140 and it went up to 160, down to 140. It just doesn't normally move like that. It's like the biggest quarterly move in dollar yen since the 1998 or 97 Asia financial crisis. These are things you don't normally expect. So when you live in a world with these types of movements, and just look at what happened after the Fed started cutting in September with their 50 bip cut. Just right before that happened, people thought, oh, it's not going to happen. It's going to be like 25 bips only. They started very strong, and that opened the door for China to do an unexpected stimulus, fiscal stimulus as well. Then you see Chinese equities, which everybody wrote off. It was one of the biggest short positions out there. All of a sudden have this staggering, 20. The FXI was up in that week, 18.5%, the largest move ever in large cap China ETF. So when you see these types of moves, it just tells you, be ready. It's not going to be just only smooth sailing. It's not like just being long equities where you just hope, it's just going to continue grinding higher. A lot of these movements are based on fear and they get exaggerated. So I think to lean into a strategy like this, there's plenty of things to do, trading yield curve steepeners, but it's not going to be one-way steepening. If all of a sudden the biggest risk now is inflation picks up, we have an inflation data coming out, CPI, on November 13th. If that comes out to be like 0.3 or higher, that's going to really embolden this recent trend of higher inflation, and that could really delay the rate cuts that everyone's expecting. So the curve could flatten on that. So there's a lot of dynamics at play that's exciting to capture. Either candidate who wins the election next week, they're both big spenders. Deficits are still, out of control. The federal debt is it's almost 36 trillion. It's growing $1 trillion every quarter. There's going to be a lot of issuance coming. Probably that issuance is going to be absorbed at higher yields. It's probably going to have to steepen the back end of the curve, but it's not such an obvious one-way only trade. It's going to require a lot of, active management. So I'd say, to answer your question, Vidak, based on so many different of these liquid markets that are moving around as it is, I think global macro strategies should be in a right place to do well, continue to do well.
Fully agree. Moving from a little bit of kind of 10,000 feet, let's go to some basics. You're the head of manager research at your firm. What are you looking in the managers? What type of characteristics? What are the red flags? Let's talk about red flags first, and then what excites you the most when you want to pull the trigger?
Sure. So we talked about the macro factors that we care about when we're underwriting managers, and it has to be, as I mentioned, a mode, some volatility, some tradable events in their markets. But once you've narrowed it down to a segment of the market that you really like, it might be convertible arbitrage, it might be ILS, the universe of managers inside of that group of strategies is still very, very large. So narrowing it down from a smaller funnel to one or two managers that we might hire in a given year, that takes a lot of work, and that's why the friction costs and that's why the trading costs of hiring and firing managers are so high, and that's why I have a team of people doing it. It takes a lot of work. The things that we care about most when we're underwriting managers, philosophically, I'd say it's first and foremost process from the investment standpoint. It can be systematic, it can be discretionary, it can be anything in between, but it does have to be repeatable. Our own work is very process-driven, and we sort of expect that of the managers that we partner up with as well. It doesn't matter how they do it. It might be all in the head investor's head, but there has to be a logic and there has to be a process to decision-making. You need to be aware of how your decision-making works, what it takes to get a position into the portfolio, and equally importantly, what it takes to get out of a position when you've either achieved your desired outcome or maybe things didn't work out the way you did, the way you wanted to. So if there was nothing else in the investment process, that's the one thing we care about. The other side that frankly is, in my mind or in my experience, just as important, if not more so, is everything that's non-investments related. It's the operations, it's the business, it's risk management, it's compensation, it's controls, it's compliance. Again, we have a separate operational due diligence team that does a lot of that work for us, but even as an investment person, when I underwrite managers, I'm laser focused on understanding that business, because at the end of the day, all of these are small businesses. There's a couple of decision makers, then there's a team of people around them, and if that business is not set up correctly, that's a recipe for disaster. In my experience, again, I've been doing this for literally 20 years. I just had my anniversary on Friday. I've seen many, many more hedge funds blow up for business and operations reasons than for investment funds. Or rather, investments, when you see underperformance, when you see investment problems, more often than not, they're a symptom of something wrong in the operational setup of the firm. It could be improper risk controls, improper governance, not compensating your team so that they all leave, not putting guardrails around what they can and cannot do, overextending yourself, not thinking about your financing at a time when there's a liquidity crisis and suddenly you're forced to sell your positions. That's how firms go out of business. The ones who place just as much importance on the operational and business side of things as they do on investments, in my experience, that's the recipe for long-term success, not just making the most money in any one year.
Thanks, Ark. Samuel, since your firm mostly invests with low net, diversifying strategies, making beta bets is not a big part, right? Could you touch on ILS reinsurance, healthcare market neutral, convertible arbitrage resurgence, or systematic strategies in general?
Sure, happy to. And I think a theme that goes through all of that, and I think an investor focus that has shifted, that becomes more prevalent, is also on earning above the risk-free rate, right? If risk-free rate is at 5%, your hedge funds have to earn 8, 9, 10%, so that at the end you have like a risk-free plus 4%-ish.
It's risk-free rate plus fees plus an excess return.
Exactly. And I think also to the multi-PM model, I mean, with Exodus Point sort of introducing a hurdle, and I think there is a little bit of that where just a lot of, in some models, there's a lot of fees involved. And at the end of the day, the investor has to get compensated for taking the risk-free rate, but also for taking the risks of sort of the active management. And so where we see this, for example, in reinsurance, you get paid on the collateral, you get the risk-free rate, and then on top of that, you get the reinsurance premium after the losses. So that's an interesting point. What we see there as sort of an innovation after sort of this bad experience is that the use of reinsurance balance sheets has come more into focus, and they are more able to sort of deal with issues of tying up collateral after loss events, and of more efficiently using sort of also structural leverage that can be used in that framework. So those are kind of things that we think is like positive innovation. And then on the convertible ARB side as well, like we believe that you're able to sort of earn the risk-free rate, and then in addition, you have sort of these additional premia that you get compensated for. And given the market structure and sort of the prevalence, like in these exchanges, it's not that all the players participate and all just the risk premia player can just participate in these deals. So in the end, these companies want like 5, 10 big investors to be able to sort of back a new refinance deal, and those will be able to generate attractive returns. And so we see sort of granular differences which allow for attractive returns at the end of the day.
Let's go back to, again, manager due diligence and get some perspective from both Rob and Jackie. You guys have been doing this for a very, very, very long time, and Art was extremely clear how he does his process. I'd like to learn more from a Bank of America point of view, and then PAMCO Prisma as well, so we can, compare.
Sure, I would echo everything that Art said. I mean, ultimately, I've spent most of my career doing operational due diligence, so I definitely have some red flag stories that I'm sure are more reserved for cocktails than for here. But ultimately, it comes down to, are you communicating what you're supposed to be communicating? Meaning basically an undercurrent, of honesty, right? There are a lot of managers that say things to you in a meeting, and then you read something in the documents, and you're like, well, wait a second, that doesn't really match up. In terms of other things, that we look for in managers, really, these are sort of softer ideas, or softer concepts, but hubris is one, right? There are a lot of managers out there who, all of a sudden they're down and they want to take more risk, and maybe they're changing their buying habits, and maybe you see them in the paper, and maybe there are things that are data points that you can pick up that are not provided in the DDQ or the marketing deck or the PPM that are useful. I wouldn't say it drives our process, but it's something that we're always keeping an eye on. In terms of other things that we look for in managers, ultimately it comes down to a long-term partnership, right? We've had managers on our platform for over 20 years. We've been around for a long time. We're in it for the long game. We want partners who do the same. We're not in it for a 3-year trade or a 5-year trade. And it's pretty easy to sort of decipher who those folks are and who they aren't based off exactly what Art said. People who invest in not only their investment talent, but also in their risk talent, and then their sort of non-investment related talent in terms of their ops people, their compliance people, and as we all know, technology, right? Cybersecurity is a huge area of focus for our operational due diligence team. The last thing I'll mention just quickly is background checks, right? Really, you can find out a lot about people that you're surprised by background checks. Again, representing things that may not be the case is a good way to get dinged pretty quickly in the diligence process, but also get fired off a platform. So, I think for us, I would say we would echo pretty much what everyone else does, but the real focus as of late have been on a repeatable process, like Art said, but really hubris, right? And I think particularly in the equity space where people are making very good returns, we want to make sure that their egos aren't getting so big that they could take unnecessary risk that we're not aware of.
Yep. Indeed. Thanks, Rob. So from an investment management point of view, Jackie, if you can elaborate, and also if you can tell us more about, once you do due diligence on managers, how do you construct portfolio?
So I'd say in terms of manager selection, it all really boils down to people and process. So understanding and identifying who are the experts. We say we like to hire people that have the expertise of an inch wide and a mile deep. So we like to construct a portfolio of these specialists, of all of these experts. We don't like tourists. We prefer people who stick to what they're good at. We have a saying in the office, we want people to pay for their own tuition. If they want to learn something and dabble in a market they're not familiar with, then they do it on their own dime, not on our investors' dime. So I'd say in terms of process, as echoed by my fellow panelists, it has to be something that's repeatable. It has to be something that hedge funds is all about alpha generation. It's not just about, someone being right. In fact, I don't care if they're right or wrong. I just want them to make money. It's all about absolute returns and controlling downside deviation, and then also as well, not being directly correlated with equities, except when equities are going up, like Vidak said, then it's okay to be correlated with equities. So I'd say it's all about that, about finding, the culture, the DNA of the firm, of who these people are, where they grew up in terms of where they trading? Did they come from the banks, run trading desks? Where do they learn their trading skills? Who do they surround themselves with? And things like that. And when it comes to market views, I think that's usually something I put at the end of the conversation, because I'm never going to ding somebody or like somebody because they agree with my market views. So I think it's independent of that. My favorite hedge fund managers are people that are very nimble and very with a flexible mindset, people who could turn on a dime, people who realize that assumptions could go away. I like people who state their assumptions first, and who say, this is where I'm in, this is where I add, this is where I stop out, and this is what's on my radar. So I like to hear people that have a game plan, as opposed to, someone's very committed about, rates have to reprice, JGB yields have to go to 2%. Maybe they're right, maybe they're wrong, but I just want, we want to invest with the people that's going to extract the most amount of profit dollars through the cycle. Because sometimes someone has a very long-term view, but they get taken out with a 1-week stop, and that's not going to help anybody. Then they sit out with their loss and they can't make it back. So I'd say that's what really matters, to be flexible and have that mindset, and quite frankly, to always be hungry and scared,
Thanks, Jackie. And Ark, why have so many managers been falling? What's the percentage in your book of the managers that you actually interview, you don't even consider deploying?
So our invested portfolio is the invested portfolio. We see hundreds, if not thousands, of managers a year. We might hire 5 of them. But even though we have advisors in the name, we are a fiduciary. We run portfolios for our clients. So when I'm talking about my investable universe, it's a universe of managers where we actually have money deployed. It's not a list where, these managers are rated higher, these lower. I guess historically that's been the key distinction between, let's say, consultants and fund-to-funds or allocators. These days, all the lines are blurred. So they're consultants, they're doing direct investing. We are doing advisory work for certain clients. So that distinction is maybe not as pronounced. You asked a question earlier about portfolio construction. For us, it starts and ends with what the client needs. Most of our business, we don't really have commingled portfolios anymore. I think we might have 1 or 2. Pretty much everything else we do is very client-centric. It's collaborative with the client, and we design portfolios based on what their needs are. Those needs might be, in very simple forms, make me the most money, which certainly puts you into certain parts of the market where high risk equals high return. But for most of them, these are institutional clients. A lot of these institutional portfolios are in the stay rich camp, not so much the get rich camp, especially as it relates to their alternatives. So for them, the portfolio solution might be risk mitigation. It might be liquidity management. It might be smoothing out their return profile in a specific scenario where they have nothing else in the rest of their portfolios that would do well for them, or be able to provide liquidity at a time when they need to be meeting funding commitments somewhere else, things like that. So that's portfolio construction for us. First and second and last step is figuring out what the client needs, and then we put the portfolios together out of our lineup of existing managers, or sometimes we have to hire new ones, which we do frequently as well, to make sure that we can fine-tune and deliver them that return profile that the clients need.
Thanks, Ark. Samuel, your firm is a family office/asset manager from Switzerland. How are managers in Europe different than US-based managers?
I'm not sure if they're necessarily super different. I mean, in the end, it's like it's one industry. I mean, we are owned by the princely family of Liechtenstein, so that's kind of our heritage, and we're Switzerland-based. A lot of our clients are also in Europe and Asia. I think what for us, I mean, one difference is sustainability, which is much more of a topic in Europe than it is in, or kind of ESG, especially around these words with. So that's kind of one key difference, I would say. But apart from that, I mean, one aspect that we might add to this panel as well, and I guess we're within the camp of PEMCO and K2, with the increased acceptance of SMAs as a way to invest as well. I mean, we've been doing that for over 20 years, and it gives you sort of this transparency and control, which alleviates some of the concerns on the operational side, and also it allows you to use capital efficiency much better. And it also allows you now, and that's kind of maybe to tie it back to AI and data, is with all of this data of having sort of daily transparency on positions and trades, I believe that that's kind of an avenue that could be quite interesting in the future, in sort of using that data better to kind of also give feedback to managers in the sense of maybe when they do something which they could be doing better, because not all the hedge fund managers are like super quants or are super focused. They're great PMs, great analysts, but they might not have the best use of their own data. So there, even allocators can be helpful in that regard.
Thanks. Let's do a TikTok, 1 minute each, about the future of hedge fund industry. Robert, 50 seconds.
So, you know, I think the saying on our floor goes, this is the year of the hedge fund, only because we're sitting next to a $70 billion private equity business. But kidding aside, I think it actually is. You know, dispersion's out there. I think in the equity space, you know, I think value has a real chance now of coming back. You know, I haven't touched on macro, but I'm a big fan of macro. I think just biggest money that I can see possibly made is also in currency, which hasn't been as ripe for opportunity in the last couple of years as before. I think ultimately hedge funds still serve a purpose. I think the advent of managed accounts has made it a lot easier for institutional allocators to get past the operational issues, to mine data more efficiently. But I would say don't sort of count out private wealth, right? The amount of growth that can actually occur in our space is exponential. If you look at McKinsey studies and BCG and everyone else, the real growth in allocating will come from the private wealth channels, right? If you look at Mark Rowan from Apollo thinks, you know, maybe ETFs and hedge funds and more liquid strategies could grow, but also the private equity business could grow from a private wealth standpoint. But so ultimately, I'll turn it over to Jackie, who I'm sure will have some funny things to say, but he's the TikTok guy. So
Jackie, you could tell us a joke too in 50 seconds.
Oh gosh, well, I was just thinking as a follow-up to my comments before about hedge fund managers. I think it reminds me of the Dos Equis beer commercial campaign. I don't know if you remember this from a few years ago, where this really wise person dispenses advice. And he said, one of the secrets to life is find out what it is you're bad at and don't do that thing. So that's the advice we have for hedge fund managers. Stick to what you're good at, you know, make money there. But I'd say, you know, with all the money that's been going into long only in recent years, private equity, private credit, it's been such a big sustained equity rally. Trees don't grow to the sky. Nothing lasts forever. There's eventually going to be some sort of repricing. It doesn't have to be a 2008 type scenario, but maybe it's going to take a catalyst of like rates repricing. Right now, nobody really thinks inflation is going to go up. If it goes up, rates are going to reprice. That could affect a lot of strategies. That could cause volatility. So I do think, you know, people are going to be reminded of the reason why hedge funds exist as an asset class, and there's going to be increasing demand for it, I think, going forward.
Thanks a lot. Art, maybe you cannot include any jokes because we have only 1 minute.
A giraffe, a cat, and a dog walk into a bar. Joking aside, I think the future of the hedge fund industry is bifurcation. The economies of scale that as a large manager you can get through investment in technology, investment in people are tremendous, and that's why we'll see the big getting bigger. But there's definitely a niche for ultra strategy specialization, finding something that you're good at and doing only that, put all of your eggs in one basket and just watch that basket very closely. And I think that's the industry will continue to migrate that way. You'll have very large players that do everything, and it's sort of like a commoditized, a single pool of risk that generates modest, low volatility returns. And then you'll have niche players in new markets that can be very dynamic, whether it's ILS or crypto or some other market that we don't even know that doesn't exist yet. Somebody who can hyper specialize and deliver really spectacular returns.
Samuel?
Yeah, I tried to do a sprint. I mean, I started after the financial crisis in the financial industry. Hedge funds have been out of favor for quite a long time. It feels like they're back. Like, it feels like we also see more interest from clients and the investors again. That's exciting. And also with some of the topics we mentioned today, what we hope to see in the hedge fund world is this alignment of sort of what the investors expect and what ultimately the hedge funds will deliver in terms of the investment outcome.
Thank you all for remarkable insights.